Hello guys and girls, welcome to episode 5. So this is where we dig into risk. Risk is absolutely essential if you want to stay in this business for long enough. Most people think they stick to risk, but they probably don't. So we're going to dive into that and make sure that you're looking at risk as a whole. Risk is not just about you risking 1% of your account. It goes much deeper than that to prepare yourself for other trades and success, but we're going to dive into that right now. So welcome guys and girls, we're now at episode 5, so this is where we look at risk. Risk is very important if you want to become a consistent trader and stay in this business for long enough. Most people don't truly understand risk. It's not about just how much you're risking. There's other things like exposure, your thresholds, and we'll get into that. And at the end, we've got an incredible mini lesson for you to go over. But first up, the 1% rule. So what is the 1% rule? Well, many people across the world, they trade the FX market. However, not everybody manages their risk or even aware of this concept. You'll hear of major losses from traders who just risk their entire account balance on one position. This is what you call gambling. At Falcon, we are probability experts, and we're focusing on an edge consistently on our side. And this is why we put in place risk management procedures that only allows us to lose a maximum of 1% of our account balance per position. This rule is in place as a means to help you efficiently reach your goal of consistency in trading. This allows us to remain low-risk traders regardless of the actual position that we're entering. Falcon students, when the knowledge is absorbed and understood, see consistent, profitable returns with little to no downside because we keep our risk capped at 1%. Now let's move on to the next part, which is slippage. So it's important that we know that we can lose more than 1%, and this normally happens with something called slippage. It's not something to fixate on, and it's important to understand. Slippage will not be the difference of whether you're a successful trader or not. Managing your risk over the year will be. As a beginner trader in FX, we recommend that you avoid at first trading through any major news announcements. While you're learning the strategy and understanding how the market moves, it's important to trade demo accounts and get a feel for how everything works at the beginning. Not to stay on it for too long because you really want to learn those emotions in a real market. Slippage occurs when a move is more volatile than usual to the point where your broker isn't able to execute your stop loss order at the desired price point that you'd indicated. This adds more risk to the table because if price slips and your stop loss, you may lose more than 1% of that trade. It happened to me a few times this year, in 2019 this is. So this happened to me, I would say about 2 or 3 times this year. You know, instead of 1%, it was 2.2 on dollar CAD, 1.3 on something else, I can't remember what the other ones were. But essentially, as you can see, it wasn't the difference of whether I had a successful year or not. But it's important to understand why it happens. These movements are usually reactions to bigger news announcements like NFP and elections across the globe. NFP not so much, it used to be a lot worse. Now NFP is nowhere near as volatile as how the markets have changed. And it's important, this is what the Falcon strategy does. It really does evolve with the market, but elections are an absolute no-no. You don't really want to be trading for elections because there's all kinds of things that can happen. But always remember, news creates volatility, not direction. We do not trade the news in the anticipation of it determining the direction of price. The structure and the price patterns tell us everything we need to know. So that is slippage in a nutshell. Now let's take a look at profit potential. So with profit potential, returns are based on your account balance and trading capital that you've got available. So any profits that you'll make will be the percentage of your account. So it's important to note because the goal with FX is not to make $1 million overnight. It's the long-term semi-passive investment strategy with the huge risk to reward. So it's important to understand that. And some of our top students have successfully and consistently seen results in excess of 15% per month, and some even managing that in single trades as far as hitting 30 to 40% trading months. Now, don't get me wrong, this doesn't happen overnight, and this is not common. Not every single trader will be hitting these kind of returns, but it's possible. But you have to keep your risk low. And these bigger months are not as hard as what you might think. And I would never put it as easy because nothing is easy, but when the impulsive conditions are in, as a side effect, you will be in trades that will naturally go on to hit things like the 90% rule, which you've learned, and it will naturally help you scale into the market. So these months will happen as a side effect of the conditions. So there's a lot of potential there. And when you start to calculate compound interest on a fairly sized trading account, even plus 5% can reap massive reward and become an income replacement. If you think about it, even 5% on just 6 figures. And 6 figures is not that big in the Forex industry. You might think it right now as you're starting off or you've been trading for a while, But when you become the asset, 6-7 figures is very, very normal. And 5% on those accounts can become very profitable. And of course, you can quit your job. There are no limiting beliefs within Falcon. No expected results. So you can never expect to hit 40, 50% or 10%. Your percentage will be a reflection of your skill set and how much work you've put in. As Falcon members, we're constantly in that state of progression. We never think that we know it all. And this has allowed us to adapt and evolve with the market. What we're here to do is to tweak and refine in order to create that freedom for ourselves. This means and results in increasing, and we're seeing this increase all over the world in the community. And as we all learn and grow from each other, that is the most important thing. We're always open and we're growing as traders and individuals. So the profit potential, guys and girls, it's huge. It really, really is. It's uncapped. But it's not a get rich quick. It doesn't happen overnight. It's not, for your average person to come in and just take a course and expect to become consistent. There is work required. There is business-like mindset required to achieve this. And this is the most important thing. If you can frame your mind now to realize that 2 to 3 years is going to go by anyway, it doesn't have to take you that long. It might do, but we've seen crazy progression in 6 months to a year for people that really apply themselves. And the truth is, this time's going to go by anyway. So you're either going to sit on your hands and do nothing, or you put in the work and put yourself in a position for success. The main aim within Falcon is to provide you with the knowledge and resources that you need to shift your mindset and create that freedom in your life through trading, and teach you how to apply it. It's not just about the knowledge, it's applied knowledge. In order to do that, we always have to keep that long-term picture in our minds. At the forefront of that long-term picture is the term sustainability. In order for you to achieve financial freedom through trading, the strategies you apply must be sustainable. And this is the very reason that Falcon is built from the ground up on sustainability and scale. It's not only the risk model we apply that sustainability in the long term, but it's the strategy itself. It continuously evolves through all market conditions and has been doing so since data goes back. Within Falcon, the entire approach is built and implemented in a sustainable way that allows us to fully capitalize through all market conditions and can propel you towards financial freedom that you desire in your life via work ethic and implementation of the strategies taught you within Falcon. It's really, really important that you're going into this with that sustainability and scalable mindset. Remember, we're going to teach you different ways how to manage. There's not just one way to manage your trade, because that's not scalable. When you try to manage something just one way, you can't capitalize on the moves. There's certain types of strategies and tools where you're only looking at a short-term management style because you're looking at a short-term trade. When you're looking at a longer-term trades, there's a different management style. And you'll find the most successful traders with actual experience understand this concept, and this is what we focus on. But what I want to do now is go into risk in a little bit more detail, bring in a bit of psychology into that as well, and show you what it means of true risk with exposure and thresholds. So let's take a look at that mini lesson now. Right, guys, so now you understand the concept of risk. Let's actually take a look at that in a little bit more detail of why it's so important for you to grasp this, especially as you're a new trader. Risk is actually fairly straightforward. Most people overcomplicate it, so let's take a look. So the 1% rule. Why do we want to stick to the 1% rule? Well, this is something that we can factor in long term. So if you want to be around for the next 5, 10 years, 15, 20 years of your trading career, this will keep you in the game long enough to succeed. Most people blow their accounts because they're too interested in getting rich quick, which rarely works. So let's take a look at it. So when we're sticking to this 1% rule, we're sticking to this risk so we can manage this. And then we understand that the risk is capped. So worst case scenario, you take a 1% loss. You're only really losing 1% of your account. That is the most important thing. Most people get emotional is because they start to feel good on a trade and then they risk more than what they should based on what they think is going to happen rather than probabilities, which we covered in the previous episode. Reward is uncapped. This is such an important concept because worst case scenario, take a 1% loss. If we're looking at a minimum of 3 to 1, then you're always mathematically on the up. Now, we know that there's a lot of trades that bank far more than 3%, and then we scale into the market, as you learned in episode 3, and really understand the upside potential when you can just stick to this. Don't play with the numbers. The moment you start thinking, well, this trade feels good, so I'll risk 2%, could be a trade that doesn't play out. It might meet all the criteria, probabilities. Remember, highest criteria of trade can still not play out. That could be the trade that you decide to risk 5%. Now you're down -5 and you're trying to chase out of a hole. It's not a good place to be. So understanding this concept is is important, but it doesn't mean that you should just take lots and lots of 1% trades. And this comes to having multiple trades open. This is where people think, well, I'm only risking 1%, so what I'll do is I'll have 5 trades open or 7 trades. They're only 1% each, so surely that's low risk. When the truth is, if you're risking, let's say, 5 positions open at 1%, you're risking 5%. So you have to understand, you need a threshold. You need something that is the line in the sand for what you stick to as maximum risk open at one given time. Which leads me on to this next part, which is currency exposure 2% threshold. So this is mine, and just like the majority of people in the community, is very similar. Some people may go as much as 3, but I would stay between 1 and 2. But you have to understand why we do this. Let's say, for example, you're taking a trade, and you could be in, say, euro dollar, right? You're in a euro pair, you're in a dollar pair. Then you might look at, let's say, Kiwi dollar. So you're still in a dollar pair. So this is why it's important, because if it turns around, then both trades can turn around on you. Now, if you accept that your maximum risk at one point is 2%, that's okay. That's your line in the sand, because when it does play out, it plays out very well. Now, this doesn't change, even if, let's say, for example, I was looking at the Great British Pound over the Australian dollar. So we've got Pound Aussie, and then let's say, for example, we've got Euro dollar, right? Completely different. So we're not dollar related, we're completely different, but it's still 2% threshold. It is 2 trades open at one given time, where one of them are not at break even yet. So that's what we stick to. And this goes into something a little bit deeper. Some people think risk is just, open trades. Yes, we got the threshold, but what does this concept mean? Having your hands tied. So this really comes down to gaining more experience in the market. Think of it like this. When you're taking trades, you've got your valid trades, your high probability trades. Now, we can all agree we want the ratio to be 80-20, right? You want 80% of your trades to be more high probability, valid more 20% of your trades. Well, think of it like this. If you're not asking good questions, so you don't have a trading plan, you don't have a checklist, why is this important? Your threshold is 2%. Let's say that you jump onto the charts, you see a trade that's valid, it's just an average low quality valid trade, and you jump into it. You see another one, then you get involved in it. Then 2 hours later, you've got these 2 trades open. Your threshold is here now. You wasn't planning enough, you wasn't focused enough. Then you notice Pound CAD, for example, is giving you a high criteria, high quality trade, but you can't now get involved in the trade. Why? Because you've got your rules. Rule-based trading is the most important thing. It's the most sustainable thing. So what does that concept really mean? It means ask yourself the question, is this a high quality trade? And take a look at your watch list and say, well, just because the trade's ready now, you may want to stay out of that valid trade and then take a look at another trade that might be ready in, let's say, 2 to 3 hours. Because what this does is it keeps your hands tied so you can't get involved in the next trade, which is the high criteria one that will actually give you the probability and give you the percentage which you desire. So it's understanding risk is not just about how much you risk, it's about the bigger thought process through all of that. Now, understand just a quick disclaimer in terms of, yes, we're risking 1%, but as we know with things like slippage, sometimes it can take us out for a little bit longer. But guys and girls, this isn't going to be the difference of whether you're successful or not. If you take a trade and it happens to be a little bit of news, it's not going to be the difference. Over the year, it evens out. That's the one thing that we need to understand. Now, before we finish up on this concept, as you can see, risk is very straightforward. Stick to the 1% and you'll stay in the game long enough to succeed. Poor risk management versus good risk management. What does it actually look like? Well, point 1, they risk on how they feel. So going back to this, they see a trade that may have the highest criteria and then they think, well, I'll just risk 5% on this one. I'll only do it once, right? Because once I do that, I'll grow my account and then I'll start sticking to the 1%. Bad habit, just so happens, remember, 80-20. Probabilities. When you're taking a trade, it might just be the 2 losses out of the 10 that happens to be that trade. And you decide 5% is the way forward on this trade because you're going on based on how you feel. But remember, we don't know our sequence of our wins and losses. So how can you know that based off a feeling that that's going to be the one? We don't. So stick to the 1%. Multiple positions open at once. So going back to this, they don't have a threshold. They just think, well, as long as I'm risking 1%, I can have 10 positions open. Well, you're risking 10% at that stage. Currency exposure is a real thing. And at scale, you'll really feel the effect on it. So think about scale, think about long term. Then the last point, which is short-term thinking, which again, just goes back to the risk. Short-term thinking, they want to get rich quick, which is, you tend to see people risking more money because they think, well, if I'm doing it now and I'm doing well, why don't I just risk 2% per trade? Why not 3%, 4%? Where do you draw the line? And that is where it really is in that mindset where you just want it to happen now. But it's that long-term thinking of people that succeed. You have to ask yourself, there are 0 examples of people with short-term thinking that actually succeed in trading. So you essentially put yourself into a category that sets you up for failure. Set yourself up for success, which leads us into good risk management. They stick to 1%. They understand this threshold. So they can stay in the game long enough to see that play out. Because you've got to understand at the beginning of your journey or the beginning of a new strategy, the beginning stage is testing. I would not see your overall performance as, right, I'm down 10% or I'm up 5%. That doesn't actually matter at the beginning stage. Why? Because you're learning, you're testing. See every loss as just a testing stage to figure out, right, that isn't a high criteria. I do not want that in my plan. You have to get skin in the game. You can read about, riding a bike all day long, but it's just theory. You have to be involved in the market. You have to take losses, build a thick skin, build your character as a trader. It's one of the most important things. But this can only keep you there long enough if you stick to 1% per trade. So this is good risk management. And to tie that off with long-term thinking, it's those that usually come in with a mindset and they say, right, I don't care if this takes me 1 year, 2 year, 3, 5, 10, etc. I want to do this because I'm passionate about it. What is 2 years or 3 years of hard work to grasp this concept for the next 40, 50 years of my life and more of financial freedom? People are willing to do 40 years of a job they don't like for a short period of retirement with not much reward. So you have to understand that long-term thinking. Those that come in with the mindset of, oh, how long is this going to take me? I want to be consistent in 3 months or 1 year, and they put deadlines on something that you can't force. Those are the ones that end up taking 5 years, 10 years to succeed anyway. And that's if they stay in the game long enough in the first place. So if you understand, those that come in with a longer term mindset end up making it happen quicker anyway. Why? Because they're more open to learning, they focus on the right things, they focus on their processes, but most important, they stick to risk. And that, guys and girls, keeps you in the game long enough to succeed. Right, guys, so now we understand how straightforward risk is. I really want you to take away these main 3 points that is going to set you up for success in the long run. So first point being a smooth equity curve. This leads back to, we don't want this kind of erratic behavior and looking at your equity curve kind of going up, down, up, down. Why? Because when it comes to friends and family or investment in the future, we want that smooth equity curve, something that shows stability within your trading, which is one of the most important things. Then we move on to the next point, which is the right habits on a small account. Remember, we're not trading our way from 1,000 to 1,000,000. It doesn't work like that. It happens in small increments. And if you can build the good habits on a small account, it will set yourself up for a larger account, which is more scalable. Then we move on to the larger account, which is the last point. Would I take this trade on a £1 million account? Why is that an important question to finish off with? Well, it comes to the same thing of risk. You want to be risking in a way that is scalable, asking yourself that question, is this trade a scalable trade? I.e., would I take this trade on a £1 million account? All of these things, as you can see with the equity curve, the right habits, asking these good questions, they all fit together, which they tie it up to create that longer term success. And that, guys and girls, is sustainable, but it's more so scalable with your trading, and that's what we want. We want to achieve that early on so we can sustain it for the long run. So I hope you've enjoyed this episode on risk. As you can see, very straightforward, but if you can ingrain these simple concepts early on, and like I said earlier in the episode, if you can stick to 1% and you don't play with the numbers, you're going to set yourself up for success in the future. You're not going on based on how you feel. You're not getting cocky and thinking, right, I've done really well of these first 3 trades. I've got a win, win, win. Guess what? Now I'm going to risk 5%. And then you feel invincible. You understand that we don't know the sequence of the wins and losses, and you bring all these concepts in, and then you realize everything that you're doing now with all of the risk in place is just to set you up for success to trade larger capital, which is the ultimate goal, but in a sustainable way. So we're now at the end of episode 5. Now you can see what risk truly means. One of the biggest takeaways of this that I really want you to think about is risk is not just about that you're risking 1% of your account. It's actually preparing you for other trades and not having your hands tied to not take advantage of other opportunities. And this is why risk needs to go a lot deeper. Once you fully understand these components, it's going to help you and avoid you to take these average trades, because naturally you'll be looking for more of the higher quality of setups when you truly understand risk.